Hey everyone, and welcome back to the Tax USA channel. Today, we're diving into a topic that affects almost all of us, taxes. Specifically, we're going to uncover some powerful tax-saving strategies that the wealthy have been using for years. The goal is to help you, the hardworking middle class, keep more of your money and potentially get a much bigger refund. It's not about finding sketchy loopholes. It's about understanding the tax code and making it work for you, just like the pros do. So, grab a notepad because you're going to want to remember this. First, let's talk about mindset. The biggest difference between how the wealthy and the middle class approach taxes is perspective. For many people, tax time is a once-a-year event filled with dread and a scramble for receipts. For the wealthy, tax planning is a year-round activity. They don't just file taxes. They manage their tax situation. This means every financial decision they make, from investments to major purchases, is viewed through a tax lens. The question is always, how will this impact my tax bill? This proactive approach, instead of a reactive one, is the foundation of every strategy we'll discuss today. It's about shifting from being a passive taxpayer to an active tax planner. So, how can you start thinking like a wealthy taxpayer? Let's start with your income. Most middle-class individuals earn W-2 income from a job. This income is taxed at a high rate, and there are limited ways to reduce its taxable amount directly. The wealthy, on the other hand, diversify their income streams. They generate income from businesses, investments like stocks and real estate, and other ventures. Why is this so powerful? Because business and investment income come with a whole world of deductions and favorable tax treatments that W-2 income simply doesn't have. This brings us to our first major strategy, starting a small business or a side hustle. This is one of the single most effective ways to unlock tax deductions. Think about it. Do you have a hobby you could monetize? Graphic design, writing, consulting, selling crafts online, even driving for a rideshare. All of these can be classified as a business. Once you have a business, a portion of your everyday expenses can become legitimate business deductions. It's part of your cell phone bill, your home, internet. It's a portion of your car expenses if you use it for business. Even a home office deduction, which allows you to write off a percentage of your rent or mortgage interest and utilities. These are expenses you're likely already paying for, but now they can lower your taxable income. The key is to run it like a real business, with the genuine intent to make a profit and to keep meticulous records. We're not talking about cheating the system. We're talking about legitimately leveraging the rules that are available to every business owner. Now, let's talk about another area the wealthy excel in: investing for tax efficiency. Many people in the middle class have a 401k or an IRA, which is fantastic. But the wealthy take it a step further. They utilize accounts like a health savings account, or HSA. An HSA is a triple tax-advantaged account. Your contributions are tax-deductible. The money grows tax-free, and withdrawals for qualified medical expenses are also tax-free. It's one of the most powerful retirement and savings tools available, yet it's incredibly underutilized. If you have a high-deductible health plan, you should absolutely be looking into an HSA. You can use it to pay for current medical costs, tax-free. Or you can invest the funds and let it grow into a supplementary retirement account for future healthcare needs. Another investment strategy is tax loss harvesting. This sounds complicated, but the concept is simple. If you have investments in a regular brokerage account that have lost value, you can sell them to realize that loss. You can then use that loss to offset any capital gains you might have from selling profitable investments. And if your losses exceed your gains, you can use up to $3,000 of that excess loss to reduce your ordinary income from your job. This is something sophisticated investors do every single year to manage their tax liability on their investment portfolio. You just have to be careful about the wash sale rule, which prevents you from buying back this same or a very similar investment within 30 days. It requires a bit of management, but it can save you a significant amount in taxes. Let's shift gears to deductions and credits. The wealthy don't just take this standard deduction and call it a day. They itemize and they look for every single credit and deduction they're entitled to. For example, charitable contributions. Most people know you can deduct cash donations. But did you know you can also donate appreciated stock? Another often missed area is tax credits, which are even better than deductions. A deduction lowers your taxable income, but a credit reduces your tax bill, dollar for dollar. The American Opportunity Credit and Lifetime Learning Credit, for example, can help pay for higher education costs for yourself, your spouse, or your dependents. There are credits for energy-efficient home improvements for child and dependent care, and many more. The wealthy and their accountants actively hunt for these credits. Don't assume you don't qualify. The rules change, and it's always worth checking the latest requirements on the IRS website or with a tax professional. Each credit you claim is direct cash back in your pocket. Let's discuss real estate. Owning a home is a great step, giving you the mortgage interest and property tax deductions. But the wealthy often use real estate as an active investment vehicle. When you own a rental property, you can depreciate the value of the building over 27.5 years. Depreciation is a phantom deduction. It's a massive tax write-off you get on paper without actually spending any cash that year. Plus, you can deduct all the ordinary and necessary expenses to maintain the property, like repairs, insurance, and property management fees. If managed correctly, a rental property can generate positive cash flow while showing a paper loss for tax purposes, which can then be used to offset other income. This is a cornerstone of many wealth-building and tax reduction strategies. Finally, the most important strategy of all: get professional help. The idea that you QATO and afford a tax advisor is a myth that costs the middle class thousands of dollars every year. The wealthy don't do their own taxes. They have a team. A good tax professional or CPA doesn't just fill out forms. They provide proactive advice all year long. They'll help you structure your side hustle, plan your investments, and identify credits you didn't even know existed. The fee you pay them is often a fraction of the money they save you. Think of it as an investment, not an expense. Their expertise is what bridges the gap between what you think you know about taxes and what is actually possible. To recap, the path to tax savings isn't about some secret code. It's about a change in approach. It's about planning year-round, not just in April. It's about generating tax-favored income through a side business. It's about maximizing tax-advantaged investment accounts like an HSA. It's about strategically harvesting tax losses, hunting for every credit and deduction, and understanding the power of real estate. And most importantly, it's about assembling a team and getting professional advice. These are the fundamental principles that can help you move from simply paying taxes to actively managing your tax destiny. By implementing even one or two of these strategies, you could see a real difference in your financial life. Thank you so much for watching. We hope this information empowers you to take control of your taxes. If you found this video helpful, please give it a thumbs up. And do not forget to subscribe to the Tax USA channel for more tips on how to save money and build wealth. If you have any questions, drop them in the comments below. We'll see you in the next video.